There is a word which is gaining more and more center stage now, which is value trap. How would you define value traps?
A value trap uh, to me means something that is tempting the investor to buy but should be avoided. So it looks cheap on a mathematical in a mathematical sense. If you look at the numbers, it looks cheap, but it is likely to remain cheap, and for all sorts of reasons. And one big part of the reason is misgovernance. At the end of the day, the stockholder of a company is a minority partner in a business which is run by other people, which is in control of other people. And if those people run it like a family business, or run it in a manner which is not really in the interest of the minority shareholders, and the market knows it, then it would obviously be selling at what appears to be cheap, and it is actually cheap, but it's cheap for all the right reasons. So value traps are things that are cheap, but are cheap for the right reasons, which means that they are likely to remain cheap, and therefore an investor should try to avoid them as much as possible. The basic idea is to look for things that are cheap but are cheap for the wrong reasons. And those, I think, are not value traps.
How much importance do you pay to macros while investing? Buffett, for example, has always said that, look, I don't care about macros. I've invested at the peak of macro pessimism. So for a value investor, factors like interest rates, fiscal deficit, currency movement, GDP growth, how relevant are they?
They may be relevant for a lot of investors. I don't have a problem with that, including value investors. I don't do that though. I am more of a microeconomic investor than a macroeconomic investor. Basically, I focus on three things, three subjects, so to speak. One is accounting, which is the language of business. You got to know that to understand financial statements and how to analyze them, and also to understand the process, how the financial statements are prepared, and how these three statements talk to each other: the P&L account, the balance sheet, and the cash flow statement, and so on and so forth. That's accounting. The second is microeconomics, how businesses make decisions, how prices are set, what is the difference between perfect competition and an iconic brand, and the whole spectrum around it. And the third is the overlay of social psychology, because if you study economics, they teach you that humans are rational and firms are rational, but actually, if you think about it, if you look at the real world, they're often not that rational. Often dumb things happen. Capital misallocation does happen all the time. And sometimes the price of a commodity drops below the cost of production, at which time it's rational to shut down, but people don't shut down for all sorts of behavioral reasons. Those come from the field of psychology. So if you combine these three disciplines, microeconomics, social psychology, and accounting, for me, I know I don't need another subject. Macroeconomics is a subject which has a lot of variables, a lot of moving parts, and I think it's very, very difficult to predict the outcome of exchange rates or interest rates, and whole lot of other factors which go into the macroeconomics field. And as a student of Buffett, I have also stayed away from making a lot of macroeconomic analysis while making judgments about businesses that I want to invest in.